Welcome to this Bennett Explains finance video. This week, how investors should approach the forthcoming EU referendum. Now, the big fight will take place on the 23rd of June, and it's between the Remain campaign, spearheaded by Prime Minister David Cameron, backed recently by Labour leader Jeremy Corbyn, versus the Leave or Brexit campaign, headed by Boris Johnson. So, what is Europe? What is it we're going to either leave or stay in? Well, this gets a little bit confusing. So first of all, there is the single currency zone, the smallest definition of Europe, if you like. These are 19 countries who've adopted the single currency, the euro, and are subject to decisions made by the European Central Bank. We are not in that club, and we're not voting on joining or leaving it. We are in the middle, the European Union, 28 countries, that's the original 19 plus another 9. It includes us, who are part of the European Union, but not part of the single currency. More about that in a moment. Just bear in mind, there are 3 countries that claim to be part of Europe, the European Economic Area, Norway, Iceland and Liechtenstein, but are not in Club 1 or in Club 2. And then you've got the Swiss, who usually do their own thing, and this is no exception. They are part of the single market. They can send Swiss nationals to London to work, for example, but are not technically in either of those 3 kind of rugby balls. So, first question is, what are we voting on? And it's, do we stay or leave the bloc in the middle? Now, this is not a political broadcast, but let's take a look at the key arguments. Just stress the key arguments. On the Remain side, you may have received your leaflet by now, who knows? On the Remain side, trade is a big one. The Remain campaign say tariff-free EU imports and exports are valuable to our economy, and we get more inward investment into the UK as a result of being part of this bigger club or being located just next to it. Immigration via free borders has been net beneficial to the UK, filling up those jobs, for example, that otherwise wouldn't get filled, and we get better security and stability being part of this club. We can share knowledge and so on, counter-terrorist measures and the like. And finally, we get better status and influence being in the club. These days, we'd be a bit of a bit part player out of it. In a nutshell, there are the arguments. Now, the flip side of this coin is the Leave or Brexit campaign saying, no, out of this club, we'll save ourselves $8.5 billion a year by way of membership net contributions, and we'll free up smaller companies, in particular from EU bureaucracy and rules and regulations. The UK is better off long term as an independent powerhouse, and greater control over our borders, greater security will come with basically being alone in the world rather than part of this sprawling club. Now, it doesn't really matter which side of the fence you're on, those are the sort of key arguments surrounding the debate. Question is, as an investor, what does all this mean? And I would say that as an investor, there are 3 phases to look at. There's up to the referendum date, there's just after the referendum, whichever way it goes, and there's the longer term. And the key to this is not to panic. Okay, explain what I mean by that in a moment, as an investor. Now, up to the 23rd of June, you're going to get a lot of what markets hate, which is uncertainty. And that will probably manifest itself in stock market volatility in the short term, sterling weakness, and that will tend to be good for exporters, put a bit of pressure on importers in the short term. Phase 2, immediately post-referendum, all depends what happens. If we stay, then you'll probably get a bit of a relief rally for stocks that boost them slightly, same for sterling, and that will reverse the pros and cons in terms of importers and exporters just in the short term. If we Brexit, watch out in the short term, uncertainty will probably put further pressure on stock prices, could put more downward pressure on sterling, and of course there'll be heightened political risk as people start to speculate about David Cameron's future, for example. And even the people who are in favour of Brexit concede that the economic impact in the short term is likely to be negative because markets don't like uncertainty, and Brexiting will bring some uncertainties. But it's the longer term case that tends to be the key one here. Now, as an investor, let's go back to some key thoughts. We're going to ignore short-term noise, and boy, will there be a lot of it as we approach the 23rd of June. We're going to consider currency hedges, if that's relevant to our portfolio. And we're going to remember that stock markets are not driven by things like Brexit votes ultimately. They are driven by fundamental underlying factors, corporate profitability, the economic backdrop, that's the US and China globally, and central bank action as much as anything else. So the question then becomes, really as an investor, what do you do? Well, this is a great opportunity to minimise the impact that local political issues can have on your portfolio, whether here or elsewhere, because no doubt about it, political risk around the world is rising for investors. And a solution I'm going to suggest, therefore, is an international approach. If you haven't taken one, consider taking one. Not just because of this whole Brexit debate, but because it makes sense these days. It reduces local political exposure. It reduces currency risk the further you take it. It picks up global themes properly. So the MSCI Global Index has an 18% weighting to transformative technology, much higher than the FTSE 100. And it diversifies your UK exposure and takes away the sleepless nights from something like a local vote. So there it is. I'll leave you with that thought. Plenty to think about there. Questions? To the usual place, please.